Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more content like this, please visit adisa.org and check out the resource library. My name is Greg Mausz. I'll be your host today. I'm joined by Brian Aleksa, who's VP at Oxford Funds. Brian, thank you for being here.
Thank you for having me.
So we're going to be talking senior secured loans, collateralized loan obligations, and portfolio management techniques around all that. Can you just start with the basics, give us a few foundations of what senior secured loans are and how they are used to create a CLO?
Yeah, sure. Senior secured loans are the senior-most debt in a corporate capital structure. So they're typically first lien, floating rate, commonly used in strategic mergers and acquisitions by private equity sponsors for leveraged buyouts and dividend recapitalizations. And they trade actively in a secondary market, which is helpful for structuring a CLO. CLOs can buy these loans in both the primary and secondary market, and these loans serve as the building block of a CLO.
And how many loans generally go into a CLO then?
So typically about 200 loans, and these are spread across a diverse array of industries. And in fact, CLOs have diversification requirements built within the structure.
Okay. So tell us more about these underlying companies. Who are these borrowers and what role do banks play?
Sure. So these are large U.S. companies across a diverse array of industries, companies that most people know, such as Uber, United Airlines, Chobani. And so the banks are in charge of effectively creating and underwriting these loans and then syndicating them to investors such as CLOs or to other money managers or to other loan funds.
Okay. And then CLO fund companies cherry pick CLOs, put them into the fund, and then are managing them, right?
That's correct. So the CLO is an actively managed SPV, a special purpose vehicle, and the CLO collateral managers are in charge of actively managing these loans. So the CLO collateral manager can trade loans, can buy loans that they think are undervalued, and can sell loans that they think are risky for that particular portfolio.
Okay, so am I to understand there's potentially two levels of active management. There's active management at the CLO level. They're managing those 200-ish loans. But then there can also be active management at the fund level where they're buying and selling CLOs based upon, I guess, broader economic data?
Absolutely right. So CLO managers that are managing the collateral are actively trading the loans. And CLO fund managers who are managing tranches of CLOs can actively trade those tranches and are looking at manager performance, duration of a particular CLO, and other metrics to kind of optimize the portfolio given a certain market condition.
Gotcha. It's my understanding that there's also primary and secondary markets for these CLOs. Can you talk us through that?
Yeah, absolutely. So when a CLO is created, effectively, the investors engage with one of the CLO collateral managers and start to negotiate on terms within the indenture, which is the governing document of the CLO, and also on management fees. In addition to that, while that is going on, the arrangers are structuring the actual CLO and also searching for investors for the various tranches of the CLO. And so, over a period of a few weeks, as the CLO is being created, once the CLO is created after several weeks, then these CLOs can trade in a secondary market. There is an active secondary market, about 3 to 6 billion in CLO notional trades per month. And so in the secondary market, you can effectively transact in different CLO tranches. And having a CLO fund manager that is willing to kind of engage the primary and secondary market is kind of an effective tool to assess relative value.
Okay, I understand that, the primary and the secondary. When I look at these funds, there's often two components. There's a distribution component where income is being paid out to investors, but there's also an NAV component, and I think managers are always trying to grow that NAV. How can fund managers create alpha to create that growth?
Yeah, great question, Greg. There are a few ways. For one thing, CLOs trade in a more opaque market, especially some of the junior tranches. So having access to information, which you can really gather through deep relationships, is one key to kind of generating those opportunities for identifying appropriately priced CLOs that you can invest in that have that potential for that NAV growth and those distributions. Another way is building out your analytics software, and that is a key component because CLOs are a very dynamic market. They're constantly changing. And so understanding how the models are interacting with the current market environment is key to generating alpha. And then lastly, it's active trading. Identifying these opportunities for relative value trades is key, not only in mitigating risk, but also in identifying and capitalizing on relatively positive risk-adjusted return opportunities.
I like that. It's driving alpha, but it's also protecting downside by this active trading concept. You talked about dynamic markets. What are some of the current trends you're seeing right now in CLOs?
Yeah, so CLOs have been very popular. There's been a lot of demand, a lot of depth and width of demand. We're seeing interest from banks, increased interest from insurance companies, pension funds, money managers, a lot of specialized funds such as Oxford funds that are growing. We're seeing an increase in the number of listed vehicles. So a lot of new demand coming in for CLOs. That's very supportive of CLO liabilities. We've seen CLO liabilities tighten into post-crisis tights, which is really generating a lot of opportunities for CLO equity investors to lock in very strong, very tight liabilities for the long term.
Okay, you're talking about locking in liabilities. Let's touch on interest rates for a minute. We've been in a rising interest rate environment, and then we held steady, and now we're actually in a declining interest rate environment. How are these interest rate movements affecting CLOs?
Yeah, so the broad interest rate movements are generally offset because CLO assets and CLO liabilities are both floating rate. There is a big hedge on interest rate movements built within the CLO structure, especially as it pertains to CLO equity in particular. But in a rising environment, what you'll often see is there is about 10% of the CLO is an unlevered exposure to those floating rate loans. So you will see cash flows that tend to be a little bit higher in a higher interest rate environment because of that unlevered exposure. That being said, a lot of times these higher interest rates can put more pressure on the loan issuers. And so oftentimes you will see some credit stress. And so you do have to kind of manage around that credit stress that you can see in a high interest rate environment. In this most recent interest rate hiking cycle, we saw a lot of resilience within the CLO market. Mm-hmm. Loan defaults stayed under the historical averages. They're now hovering around 1%, nice. Which is below the historical average of about 2%. And so overall, the interest rate hiking cycle did produce stronger cash flows without having overly punitive credit issues within the various loan portfolios. Now, in an environment where rates are going down, in the short run, you might see payments that are going to be slightly diminished because of that unlevered portion of the CLO equity portfolio that we discussed. That being said, an environment where rates are falling is going to be conducive to more economic activity. There's going to be a lot more of those LBOs and those M&As, and with the added loan supply and overall economic activity, that will usually be supportive of loan prices. So you'll often see support for NAVs and overall loan prices, and then in a kind of thriving credit environment, you may also see a widening of spreads as there is an increase in overall loan supply.
Well, and that's good for the returns of CLOs, right?
Yes.
And I'm also guessing that as floating rate loans go down, defaults are going to continue to go down too.
Absolutely. And we have seen environments where there are idiosyncratic defaults, which can cause issues within a CLO. But broadly speaking, rates actually coming down should be conducive to a more benign credit environment.
So we've been talking alpha generation, which is great, but what techniques do fund managers use in this asset class to kind of mitigate risks?
Yeah, that's a great question. So some of the key techniques, it's really about analytics and managing risk within the portfolio and seeing some of these kind of risks popping up and addressing them before they become major issues within an individual CLO. A lot of that is really just maintaining an active dialogue with CLO managers, and of course, integrating a lot of the monthly reports that come through into your analytics so you can monitor for any kind of issues that are coming through. But it's really comes back to active trading once again. So maintaining that dialogue with those CLO managers, running the models, and understanding what the new reports and the new trends are within each individual portfolio, and then being proactive and actively trading the portfolio as well.
Yeah, keeping your thumb on everything makes complete sense. So let's talk application here. Who is investing in CLOs and who should be looking to invest in CLO or CLO funds?
Yeah, so we've seen a lot of institutional interest. We're also seeing a lot more public interest. So certainly a lot more of the retail crowd as there is a rise in listed vehicles as well as interval and tender offer style funds. And so we're seeing a big crossover between institutional and retail interests, which has been really supportive of the overall CLO market. So on the whole, I would say anyone who's interested in these high upfront cash flows, which can reduce the overall duration of your investment, the overall diversification benefits from having these CLO vehicles, which have those diversification requirements that we discussed, and then also just being an alternative asset class that might not necessarily be correlated with a lot of other investments that an individual investor might have in their overall portfolio.
We really have seen the rise of retail CLO funds in the marketplace, and I think it is it's high time that people start looking at this more. And you just articulated the things that retail investors really want. They want that income. They want that diversification to create non-correlation or further non-correlation between all the different asset classes that they have. So fantastic, Brian. Thank you for walking us through these basics stats, but then also getting into the weeds a little bit on how these CLOs work and function. Really appreciate it.
Absolutely. Thanks, Greg.
And thank you for watching another episode of Focus on Alternatives. Again, for more information like this, please visit adisa.org. Thank you.